Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, October 24th, 2024. It's 10:36 a.m. Eastern Time. I'm starting the video, and I'm just going to go over briefly some of the things I'm watching right now. So it won't be all inclusive, but I'll kind of hit on some of the recently highlighted trade ideas, which ones stand out to me right now. Again, not an all-inclusive list. There's a lot of stuff out there. Gosh, got dozens of trade ideas out there in the last month or so. But let me start out here with SPY, the S&P 500 ETF, which gave us a sell signal yesterday. There was comments have been very quiet lately. I guess people are just the markets, and that's a function of the market's been grinding around. I just said earlier this week we hadn't had any new news to report in the market for a while, and then yesterday we had the breakdown. Like I said, I was covering it on Tuesday while it was breaking down, but I said, if you have to squint, give it the benefit of the doubt, say you're still on the trend line. But we did close that day below, and then yesterday was a solid follow-through day. So to kind of recap, we hit got out to right when we hit the first support level and expected a bounce. So that's what's happened. So you could, number one, if you missed it, there weren't a lot of comments yesterday. And I also know that, again, I've been doing this a long time. I know most people don't want to short right now with the S&P right off all-time highs. That's great, and that's fine if you don't. But that's right about where I had the bounce going. You can see there's, some minor support right about here to here. With these bottom of these candles, see, I put the crosshairs and I catch the bottom of these candles right here, especially that most recent one. So somewhere in there, and if we go a little higher, back test would still be objective. Now, one of the subscribers commented on that. There were two comments today on the last post I gave yesterday on natural gas and SPY. I kind of just wrapped them into one to keep the, so I don't flood your inbox. I already got enough posts out yesterday. This is the BOD, benefit of the doubt trend line they mentioned, and that's certainly legit. So basically come off the same August 5th low and come in and capture, see the bottom, the shadow here of that long shadow on that candle there, and then that would come in and capture bulk of the shadow of yesterday's candle. So certainly potential. My reply was, yeah, if we do get a reaction, number one, if that holds and we start to bounce off there, now we have a third and confirming reaction. In my book, I don't know if this was ever written anywhere, and not that I wrote a book, but I'm saying in my style of technical analysis, I need to see three distinct reactions, not like one here and then the next day and then, another one there. That would be a cluster of reactions. This is 1, 2, and that would be three distinct reactions to validate a trend line. Why is that? Because any 2 points can be connected at random. So 2 points to me don't make a trend line. It's that third confirming reaction. But my reply was I still prefer the one I had drawn. The way I always say trend line drawing is more of an art than a science. But I've been doing this a long time. I usually have confidence in my trend lines. I will adjust them as the charts change. I always say that. I'm not married to anything. The charts are dynamic. They change every single day, and so I will modify trend lines as needed. But so you have 1, 2, and then multiple candles there on that cluster, and then multiple reactions right here, then there, and then the breakdown. So as of now, I'm still favoring this one. But like I said, that's a potential. But more so, I'm going to take it away. If we bounce off there and then that becomes the trend line, that's it. I'll just pull this one down and put it there. But as of now, that was support yesterday. As you can see, it wasn't just a random level. I showed it to you on the 60-minute and the daily. We had a lot of reactions here and a little consolidation sideways trading zone, and we broke out. And we just back tested it. So that's the level that needs to go to open the door to T1, T2, T3, and T4, right? Simple stuff. So set a price alert, break below yesterday. So two objective entries. As the arrows I drew yesterday in the post I got out to you, I had it going up to about here and then down. So you can short on the bounce. So again, there's minor resistance there. Or in a back test of the trend line, but not above. If it takes back the trend line, then that's it. You'd be more concerned about stopping out at that point, but definitely not add if we get back above the trend line. All right, so that's it. SPY, not much more to talk about there. QQQ, kind of doing its thing too. And this is the trend line I gave you, I believe, in yesterday's video. 1, 2. That's a cluster reactions, and we do have a confirming reaction. We bounced off that yesterday so far. So same thing, really. Also have price support just below. So it's, to me, pretty simple. We need to take out yesterday's lows, and if we do, that would open the door, in my opinion, to another kind of quick swoon down to the next price target or targets. Okay, let me move to where there's probably better profit potential, at least in the very near term. Silver. So I gave you a pretty comprehensive update on the metals and miners yesterday. This is the most recent divergent high. As I said, a beautiful bearish rising wedge, nice, clean, well-defined uptrend line, lots of reactions riding up there, breakdown. And now you also have, I've never historically been crazy about head and shoulders on 60-minute time frames. Historically, they were patterns, that you would recognize, and they would play out on daily or weekly time frames, taking weeks or even months to form. However, I've been doing this a long time, and I've seen a lot of what I'll call rookie traders, or part-time technicians, folks that use technical analysis, just getting a lot of patterns wrong. Head and shoulders are topping patterns; they're not continuation patterns, and inverse head and shoulders are bottoming patterns. And so, point being, you look for a head and shoulders at the top of an uptrend. I've seen a lot of, I say that because a lot of traders have seen them in the middle, and but here's the thing: it's a self-fulfilling prophecy. If enough traders look at that, and where I'm going with this is on a shorter term 60-minute time frame. If enough traders see it and treat it as such, then that's all that matters, because all that matters is if it breaks there. So what you have is, again, it looks like a clean, you have the divergence, you have the wedge break. There were, like I said yesterday, a lot of other reasons to be short silver right now, but that's just beautiful symmetry to that pattern there. Here's your neckline. Just below, I had that previously marked at 33,747. You want to give it the benefit of the doubt. Come in and see these. Here, let me come in tighter so you can see it in the video. You can see a couple lows there yesterday. So I'll just put the line right there. Right around those spike lows. And this is what you call a neckline. So look, if you're not familiar with head and shoulders patterns, look it up. That's called a left shoulder, head, right shoulder. And this is your neckline right there. One of the things most, newbies do or don't do on patterns or scrub them for volume. If you read up on these patterns, stockcharts.com has a great resource. Their chart school, they'll talk about these patterns and others. What you want to see on the head and shoulders to confirm it with volume, because a lot of traders don't. And if you don't confirm technical patterns, whether they're bullish or bearish patterns, if they have volume criteria, you're just, if you confirm it with the volume criteria, it increases the odds of it playing out. And so what you want to see are two things. You want to see increased volume on the formation of the head, meaning coming off that move down off the head, and then again off the right shoulder. Doesn't matter here what's going on the left shoulder, doesn't matter volume up. You want to see increased volume, and that's exactly what you see here so far. So it meets the criteria. The one that's lacking really is the time frame it's on. And again, 6 to 1/2 dozen doesn't matter. What does matter is that's price support. So maybe this is head and shoulders, maybe it's not, whatever. There's price support, and a break of that level should take you down to my next target. Still favoring a pullback to this, oops, that's not it, to the uptrend line there. And that was kind of shrunk it back. That trend line comes off the lows right there, September 6th. All right, and then, of course, I already did gold and GDX yesterday. I'll just give you an update on GDX right there. Beautiful bearish rising wedge breakdown, nothing but selling since. Coming up on my first target now. Next target's going to be that intersecting 4011 and uptrend line. So obviously you got to take out upon the initial tag each target. Reactions likely. So we need to get through that $42 level, and if so, then there should be another at least 5% downside in GDX there. Another one I'm really looking good lately is natural gas. Highlighted that on the breakout above this downtrend line. We're now at that first or 1396 target there. We break that, you can so forth and so on, and I have pretty aggressive upside targets here. It's really one of the same trade, or we've been in and out. Again, I'm an active trader. I'm going to point out these divergences. I'm going to point out, give you stop loss levels, which we're already hit. The tight stop there, or short on the wedge, or get out of your long on that bearish rising wedge break. Or big picture, again, the long-term charts. I don't cover this every day or even every time I cover natural gas, but I've covered this quite a bit in the last several months. The longer-term constructive charts, the daily and weekly charts that say natural gas could be coming off a major bottom. It is definitely at the low end of its price range. A positive divergences, everything. So remember, longer-term constructive chart help formulate why I have such a aggressive targets. I mean, from this, these double divergent lows back there in UNG, and you're going to get better on natural gas futures. That's my proxy, but that's a 71% profit gain from those lows if T8 is hit. All right, so let me show you the futures because I just rolled. Okay, yesterday's post, I might have referred to this as a 60-minute chart, but if you go back, I've been covering nat gas, the futures on the 2-hour chart here. I mean, that's not what I wanted. All right, and so that's what I gave you yesterday in the recent charts, and the volume up until today was higher on these. Now we're rolled over to, so I'm going to show you the chart in a second. But the last update I gave you a couple days ago, I told you we had minor resistance at 237, which needed to be taken out and would trigger the next buy signal. This is textbook trading, and if you're even natural gas, if you're an active trader, we popped it, and it was immediate in one candle right there. Remember, these are 120-minute candles. We spiked, one of the biggest spikes that we've had in a while, and it wasn't random where we stopped. We hit my first price target. Remember, I had arrow breaks. That's arrow break denotes a reaction. I had going up here, breakout buy signal 1, buy signal 2, buy signal 3. And so as an active trader, you could have reversed that long. It gained the pullback off of 2.442, and then look where it stopped, perfectly back to the break point. This is, remember, resistance once broken becomes support. This is technical analysis 101. So if you missed the breakout, you had another opportunity on the pullback to support. Right there, perfect tag, and then boom, look where we're back to now. And the way it works for me is that once I've gotten that initial reaction off a price target, then it doesn't mean you can't get it. It's still resistance. It just increases the odds that you're going to go through it sooner than later. So at this point in time, in other words, I'm not as keen to play pullbacks after we've already had the initial pullback. Now you're waiting for a breakout above that level. Let me show you the December. So when in futures, when you roll contracts, you have price levels are going to be different. So I had to mock up the chart, and that's what I did today. I'll show it to you. Okay, I actually did use a 60-minute chart this morning. And we'll just work off this one for now. That's the same comparable level that we just hit yesterday at yesterday's highs, and that's that same price support. But see, the price levels change, and this is it. So now this is the same downtrend line. That we had the divergent low. You can see all the divergent highs and lows, divergent low, bigger divergent low. The divergence got bigger. We had a rally, ended with that divergent high. We had a price target right there, again, on the previous contract. And that's it. Simple stuff, guys, right? So now we just need to break above. We had a little spike there. You might want to put the lines because, again, this is the new contract right above these two highs right there. So today's highs, we break today's highs, that should open the door to the next target or targets. There's an uptrend line for those that want to keep tight stops and or buy pullbacks too, as long as this trend line's intact. That's the pullback we had yesterday. If you want to have tight stops, you can have it under it, but it all depends on your entry. I can't give a one-size-fits-all stop on a trade that natural gas is volatile, and I don't have to. If you traded it for years, I don't have to tell you that. So, as an active trader, if you're in out, or even less active but not micromanaging, but managing a swing trade like I often do, well, I'll think something's going from point A to point B, and that might be a 100% run, but I'm not going to sit there and ride out the 20-30% pullbacks. I'm going to try to game them or sidestep them. So that's and therefore. And there's multiple entry and exit points. So that's it. Just wanted to point out, break of today's high should open the door to the next move up. And you have some support levels just in case it craps out and heads down and takes out the recent lows or anywhere above there. You can little support levels along the way there, but like I said, somewhere in here, ideally, that we're starting to move up. Would be the best kind of trades is when natural gas just keeps, pullbacks keep getting bought up, and it just has these powerful, like a powerful downtrend, powerful uptrend, and it doesn't let the shorts out or the longs in. That's what I like to see, those kind of full throttle up kind of moves on natural gas. So until we take out these highs, it's still, who knows if we'll get that or not. But if we do, those are two big previous reaction highs up there at about 340, and that should really rock if we can break out those levels. I don't have much of an opinion on crude. I'm just going to cover this in case anyone asks. It's kind of just choppy and erratic right now. Down today with nat gas. Natural gas is typically, especially in recent years, have been trading inversely to crude oil. I think that's a function of, I'm not an expert in the field, but I do understand that when crude prices go up and they're at the high end of the range, the wells are gushing. They turn them all on. When crude prices fall, especially down below certain levels, they start capping wells. It's not as cost productive to pump, when crude's cheaper, and that's it's a variable slide thing. So, but what happens is natural gas is a byproduct of crude products coming out of the ground. So when the wells are capped, there's less natural gas coming out too, and that's why you tend to see crude prices going down and natural gas will often go up, and crude's high. And then all of a sudden they start turning on all the pumps, and there's a ton of natural gas floating around. So anyway, you have the levels. It's all technical. We've got to wait for a breakout of today's highs in nat gas. What else? Semis, SOX, it hit that T1 again. Remember, we had a divergent high there. We hit the first target, we bounced, extended a slightly higher, still divergent high. So this is support. So this, just like a lot of things where we need to take out today's, this recent low. Was it yesterday? Yeah, yesterday's low. Yesterday's low. To trigger the next sell signal. If you look closely, that's the level I've had there, 223.25, but you can see a slight spikes below there. All those 60-minute candles closed on it, but then you had a slight spike below too. So again, it's yesterday's low, which is a little bit below that level right there, about 223 or whatever it is. 220, 290, and that should open the door for the next leg down. To be bearish and short the stock market, give you the sell signal on SPY yesterday, obviously is to most likely, or most of the time, and now is to be bearish on the semis. And of course, the ultimate fate of stocks depends on NVIDIA. NVIDIA, like I said, gave you a tight stop, suggested stop, but I still very much like this one. It's still long-term. My long-term targets I maintain, even these near-term targets, if you gave it a little bit of room. I've had a lot of folks, quite a few members ask for suggested stops. I'm typically going to look at it, place it tactically, strategically, but also use about a 3-to-1 RR. And so if I don't give you a stop, use whatever stop risk reward ratio you like. What does that mean? So, if you short it here, and that's where it was, you go down to T3, that'd be a drop of 10 point, almost 11%. So you can give yourself, that one was actually pretty tight. I had about 2.34%, which was, wow, it was probably a tighter stop than should have been there. But either way, it's, new trade, same trade. That's still just a beautiful, nothing's changed. In fact, the divergence that we had in place at this high, it's gotten larger. And, like a lot of things, there's some minor support here. Need to take out those lows, and then that'll happen there. We'll go down and probably hit that third target. They've got, NVIDIA's one a kind of an outlier, almost all the semis, most of the important ones, and the big tech, the Mag 7, all but NVIDIA tend to cluster. They report around the same time in the coming week or so. But then you got this one is kind of an outlier, tends to report after about almost a month later, a few weeks later. Let's talk about earnings real quick. If you're new to the site, just go to the top menu, click on resources. I do this all the time. I use these tools of the trade, earning calendar and economic calendar. I'm checking these almost on, especially on earnings season, all the time. And so you have, this is kind of this week. Here's who reported today. You can see UPS. We had a trade in there, gapped up our advantage. As I mentioned, when you have a, what you need to do when trading, I like OCO orders. One cancels the other, so you go long. Once you enter a long position, turn around, put an OCO trade in. One cancels the other. That's a stop loss at where your stop's going to be, and a sell limit order at your price target. Set them good to cancel. Set and forget. Gives you discipline in case you're not in front of the computer. It'll be filled. And, as I mentioned, when you have a, that's the way it works. So gaps can work for or against you. If you gap down beyond your stop loss order, you're going to lose more than you allotted for. And if you gap up above your price target, you're going to be filled at the open. And it works out in your advantage as it did today for that one. So those are the ones. Obviously, I don't have to tell you if the chart was bullish. That's why we're long. AAL, American Airlines. Let's just look at a few of these real quick. I haven't even checked them, honestly. Let's see, AAL, that one. Oh, obviously I had that big divergent low there. I haven't touched this chart in a while, so that was a bullish chart, but right into resistance. If I was long this stock, if I had taken it in earnings, I'd be selling it now. Let me just tell you, it's a short right here. Down, beautiful. I had this line was already here. The big old gap. Traders love those gaps. And downtrend line, that's double resistance. You can short this stock with a relatively tight stop above the downtrend line. Your RR is very favorable. And where to? At minimum, I think right here, your target pull back to this level. You have the bottom of that gap there. And you also have a potential uptrend line that may form even if this thing's going to keep going. So you could risk short it here with a stop right there, 4% stop loss to make at least 9%, and quite possibly more, because if you look at bigger picture, turn off all the lines, like many stocks, if you aren't a Mag 7, or even that Mag 7s, a lot of them have peaked. This stock's in a bear market. That is an unmistakable downtrend. I don't care how screamingly bullish you might be on the airline sector. You cannot argue this is it's a downtrend. It's stock making, especially, bottomed here. We have pretty much a double bottom. That was long-term support, but from this point too, it's been making lower lows and lower highs. So that's what you do in a downtrend until there's enough evidence, and the 200-day moving averages, although it's traded through there. So that's it. So take it, don't take it. But that's a potential trade up right here. Okay, the next two that were on that earnings report for this morning were LUV, Southwest. Again, very bullish chart. I didn't play the game here this time on these guys. I do it a lot. I'll go through what before stock reports. If the chart is clearly bullish or clearly bearish, that's usually the direction it's going to go. And so you had a divergent low, and this thing's been running up, but it ran into downtrend line resistance. It's sold off since open. It opened about flat, so it's really a non-event so far. But it is also it's also in a downtrend line and at resistance. Now, if it breaks this, look, if you're a glass half full guy or gal, especially with airline stocks, there's your long entry. Break above this trend line, that's going to be bullish. It's your downtrend line right there. And you're coming off a divergent low. However, look how many, this is what happens. This is what I talk about a lot. In a bear market, divergent lows, they're great for swing trading. That's why this is me. I don't care if something's in an uptrend or downtrend. I'll swing trade it. We've had plenty of shorts on the stock market last year or so, and plenty of those have played out. And it's the same thing with these. You can, look for these divergent lows and you're going to get pops, but it's a bear market, so it's followed by a new lower low. And so if this one takes out, look, you have that major double bottom there. That's going to be quite bearish for the airline sector. All I can tell you right now definitively is the stock just ran into resistance. It's got and you can short with a stop somewhat above the downtrend line. And if you want to tuck it away, not my favorite. These things are already beat down. I like picking tops better than shorting. It's something that's near 52 or multi-week low, unless I think it's going a lot lower. Anyway, my point was I just wanted to go over the who was next, the earnings, HON and then NASDAQ. We'll look at those last two. Again, I haven't even looked at these, so let's see what we got. Honeywell. That had a clearly bearish chart. Again, I haven't touched this. This last time I updated that was, I actually would have done it yesterday. Oh, I must have covered it in a video or something. Yeah, this uptrend line, that one was created on September 11th. Either way, yeah, divergent high. I guess I covered it in a video. I don't even remember I covered this. So, oh yeah, I was covering the defense stocks and all that, or the industrials. Divergent high, and it's gone the way so far of the charts. Negative divergence, but this would be a much more powerful sell signal to break that trend line. And then NASDAQ and DAQ, I think, was the other one. That one, divergent high there. You had a trend line right there, breakdown back test. So although it's up today, I think this one will head down from here. And not one of my favorite, but you can make a case to short it on the breakdown and back test today after earnings. All right, let's go through the rest real quick and see who's reporting. That was it's already happened. That was this morning. This is tonight. I don't see anything with market moving there, so let's just jump forward. Colgate, yeah, another community bank. Nothing really HCA, big company, but nothing market moving there. Friday, nope, you don't get anything Friday after the close. So the real fireworks start next week, guys. I'll just click through here. You've got McDonald's coming up, AMD, Alphabet, big ones right there. Obviously Visa, that's on Tuesday after the close. Wednesday morning, Caterpillar, Lilly, Microsoft, Meta after the bell on Wednesday, and then you've got Uber, Peloton, Merck, and Sirius on Thursday before the open, and then to wrap the week up, you've got Amazon and Apple and Intel. Intel still a long trade idea, but it's just kind of stalling out. I'll update that. Let me update all of those. In the big ones, Intel. We went long here, hit our sold target for a 30% profit. Then we recycled back in here on the pullback. We hit, and that was based on the 60-minute chart. We hit the first target, made it a little bit past that. We're back to entry point, so it's there. Still constructive chart. It's just kind of grinding around sideways, but it's still holding this support. Remember, this was a basing pattern it broke out of, and it's been back testing. That was the whole premise for that trade. As I said, we have Apple, Amazon coming up next week. That's going to be really set the tone for the market, and they'll bring it home. Clearly bearish chart to me. A big divergent high. We had a divergent high wedge break. We got that pullback there. We covered, that was the morning of August 5th, the lows. Went long everything, covered all shorts, and we've come full circle. The divergence, we have an equal, maybe even a slightly higher high. It doesn't matter if it's equal or marginally new high. Steep divergence in the indicators, and this one's headed a lot lower, in my opinion. So Apple goes south following earnings, according to the chart, at least by my opinion or my analysis. Alphabet, this one already broke down. You had this uptrend line right here, breakdowns, back testing, that's bearish. Put in a divergent high. Like I said, so many fangs have already peaked. Broke down there from that beautiful cleanup trend line. There's that August 5th lows, or was that the August 5th? No, that was the August 5th lows. This one made a marginal new, but then divergent low, back testing the trend line. Either way, they're all these big fangs are longer term bearish looking charts to me, so that's the way I think they go after earnings. Which ones did I miss? Microsoft needs to break that trend line, already peaked back here. So this is kind of it's funny because it depends on whether someone's wearing bull goggles, bear goggles, or just market agnostic. If you're glass half full, you say it's okay that big tech's been sucking wind because we're seeing sector rotation, and that's healthy for the market. There's others that say when big tech stalls. I've seen it happen in 2007. I saw it happen in 2021. Remember big tech? We started shorting the NASDAQ in November 2021 when it peaked. The S&P continued higher, just like it has recently. I'll show it to you. Back here. Turn off all the lines. This was the high in the NASDAQ 100 and most of the majority of those FANG stocks collectively, and we had sell signals there on the wedge breaks, but the S&P didn't peak until the beginning of January, just like we had a peak here in the NASDAQ. And again, I've seen it many times over decades now, where when the market leaders, which in recent decades have been the big tech stocks, when they peak first. You get that breadth thrust. Your market starts to, for whatever reason, the leaders start to, see rotation out of there and people moving into other things. And it's invariably, I see them, majority of pundits spin that as bullish, but then that marks the top. So you've got to note the divergence like you had back then, right here. Divergence between, with the NASDAQ 100 peaking and going lower, yet the S&P 500 or broad market at that same point, continuing to a marginal new and divergent high, then top coming. So that's the way I still see it now. And, things change and we change, and I change my outlook, and that's it, and change my positioning. But until then, we're gonna, and always I'll continue to spread it around. And things like, I still like the ag commodities. They're not really screaming or anything, but wheat still broke out of that basing pattern here. Really nice support. Remember, we had a divergent low breakout there. We hit T1. T2 hit with divergence, so we had this correction, then we broke the uptrend line there, but it's taken us back to the key support right here, which is also the top of that basing pattern we broke out of. So if we can hold that support and rally, then we should go on to hit the additional targets. Corn and soybeans been doing a little better recently, moving up. Corn holding this support right here, 1754. Do I have, where are my targets? Must be on the daily, right? Yeah, there it is. Divergent low, breakout, still holding above the breakout and the divergent low. Hit that 1744 support and needs to take out that 1882 level. And then soybeans, same thing, broke out, put in a divergent low, breakout, and had a correction and needs to go up and take out that previous high. And then we'll have, at that point, we may start to get the makings of a new uptrend if we can put in higher lows and start making higher highs. Treasury bonds, another way to be diversified. Here's that 60-minute chart. We still have the positive, aka bullish divergence. We shorted it here. We hit the final target there. Then we went long. Where was it? Right here. We hit our sold target there. And now these are the targets for the next pop up. And when you look at the long-term charts, this is TLT here. You have, this is a daily chart. Uptrend line right here off the lows and price support, and then TYX, which is the yield on the 30-year bond, that also hit that downtrend line. I've been targeting right there, and that's where we're at. So you had the divergent low. This is yields rising. This is us being short treasuries, and this is us gaming the counter trend moves there. And so there's your update on treasuries. Now this, I would almost love to be wrong right now and see us break out and rally up, because then that would be very beneficial to all the shorts, index shorts, semiconductors, things like that. You're already hearing rumblings now, and we know that the mortgage stocks have gotten beat up, and home builders are starting to get beat up because of that rise in rates. Remember, the Fed's lost control, and maybe it's a short-term thing. There's still a lot of hopium built into this market. Still those calling for additional rate cuts, but it's having the opposite effect, because the Fed is cutting with, according to the numbers, if you believe them, unemployment's still low, and employment job market's strong, and retail sales have been holding up. They've been all over the place. So the numbers have been kind of coming in all over the place, but generally the consensus is the economy is doing fine, and you had the Fed embarking a rate cutting cycle. So what is that going to do? It's going to spur further economic growth. I mean, the market can't have its cake and eat it too. It wants the Fed to cut low rates, but it wants the economy to stay strong, no landing scenario and all that. Well, if they do that, they're going to reaccelerate inflation and at the very least long-term economic growth. So, you can't have both. So if the stock market stays strong, profits stay strong to support these high valuations, and there's more growth, you're going to see long-term rates continue to rise. And we can already see the problem. We have new home sales, home sales in general, plunging down to unusually seen low levels. Nobody's selling. Nobody can afford homes right now, and you have mortgage rates ticking back up. Look where we're at. I mean, just look at where the yields are. If you do it this way and kind of, think about the impact that it's had on the market, compare it to the stock market. So here's where yields have been. This is where everyone thought rates were going. Well, not everyone, because we went the other way. We bet that rates would go up by shorting treasuries. But the pundits out there, all the so-called smart people that come out on TV and CBC, thought rates were going to go down, but they went up after the Fed cut for the reasons I stated. And so if that. Well, let's just go. We're back to where we are right now. So here's what happened. Rates went to this level right here. I'm going to draw a line. So we're back up here. Remember, it was these rising rates that just were knocking the snot out of the stock market. So we're at the same level. The S&P was here. Was when we were trading at these levels here, 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 and now yet the S&P's higher. All of a sudden. As if high rates don't matter anymore in the stock. That seems to be the common consensus right now. That for the first time in history, everything you learned, I'm a business major, economic courses, former stockbroker. The one thing that's just nearly an immutable fact that rising interest rates stifle economic growth and are also unfavorable for the stock market for that. Plus the other reason, it's the alternative when individuals and especially institutions, think pension funds, etc., things like that, start having an alternative. And the Fed said it. Bernanke outright said it, and we know this to be true. I mean, if you're in the field, that the Fed will cut rates to not just spur economic growth, but also to force money out of the stock market. Out of safe haven CDs and Treasury bonds and into stocks. And Bernanke explicitly said that back in the financial crisis. We know it to be true. I'm sure that Powell said it. And that's what happens is when yields go up, you have an alternative, and you can lock in, let's say 5 and then 7. And again, it's the higher you go, there will be more and more money shifting out of them. Maybe I'll get that historical 8-9% return, 10% in average annual return in equities, but I know I'm risking 50% bear markets because every so often those come along and I can lose half my money. Or I can get a guaranteed 5, 6, 7. So it's an incremental thing. And the higher rates go, the more money will shift out of risky equities into safe haven guaranteed investments. And so that, like I said, and so far the market is just shrugging that off. But that's a signature move of a bull market that gets in a mature bull market. You can see all the signs out there. This market is rife with speculation. I commented on that the other day. Interactive brokers now telling me you can bet, which is it's an outright casino. You can bet on the elections, not just who's going to become president. Will the Democrats control the House or the Senate? You can lay your bets there. You've got binary options now, single day options. You can bet if you want to gamble if the stock market's going to close up or down today. I think it's just I've never in my life. I shouldn't say that. There were a lot of signs of bubble, especially back in the 2000s with .com. But crypto, if you look at what's happening and just take a step back, and when the history books are written, you will see these things. And it just speaks to the scope of the move when this casino finally ends this time around. Like I said, we're probably looking at 50+% losses in the stock market. And, that could take a couple years. But remember, stocks tend to fall a lot faster when they rise. But this is what I wanted to mention, that we're at resistance in treasuries and on yields, which is support on the treasury bonds. But if they break out in longer term, I still expect higher rates. That hasn't changed. I'm just trying to thread the needle and get the little zigs and zags. All right, let me turn that off. There we go. Let me just wrap up here on Tesla, because Tesla's the big mover today, up 18%. On the 60-minute chart right here, you can see heading into earnings that they reported last night. you had a little divergent low, positive divergence, just like you had a divergent high here, just like you had a divergent low there, divergent high. Watch, rinse, repeat, right? This is a 60-minute chart. So what do you have now? You don't have divergence, but you do have a back test of this trend line. Remember, we recently broke down, breakdown. If you missed the breakdown, you had an opportunity to short on the back test. From there, dropped about 10%. It's up big today and coming up on a back test of the trend line and price resistance. So close enough that I can't make a screaming case to short it, really, but I could make a case short it here with a stop, relatively wide stop, and more of a bear market play. Kind of short it, tuck it away if you can give it a decent stop, not too high. The bigger picture is this has been the bear market downtrend line. I've talked about it quite a bit recently, and it keeps trying to break out and keeps failing. Right here, fail. This is a weekly candle, so it doesn't matter how it closes until tomorrow at 4 p.m. So if we somehow get rejected, it'd be a pretty heavy fade. Then that's going to be bearish. And at this point, we've had a couple spikes, those failed breakouts above. You could draw a BOD or alternative trend line, and there's your new downtrend line as well. So any rally up to that level, you could also make a case to short it. That's it. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart.